Warning. The VIX just collapsed 44%.
But here is what nobody is telling you.
Every single AI stock is still in crisis regime.
The exact same setup that preceded the March crash.
The regime detector called it 6 days early last time.
And right now it is showing the same divergence.
Let me put numbers on this. VIX peaked at 31.05 on March 27th.
That was the tariff panic. Everyone remembers that spike.
Today. 17.48, a 44% collapse in 3 weeks.
That is the third fastest VIX normalization since 2020.
The market is pricing near total complacency.
SPY hit an all-time high of 710.14 on April 17th.
Meanwhile, our regime detector shows AI stocks have been in crisis for 40 straight sessions.
Palantir, Nvidia, Oracle. All crisis. All 40 days. No relief.
PLTR realized vol, 61.9%. That is 3.3 times SPY.
Oracle at 62.8%. These stocks are moving like it is 2008.
But the VIX says everything is fine. That is the divergence.
The last time this specific pattern appeared? March 2026. And before that? 2000, 2008, 2020, and 2022.
Let us walk through what a 44% VIX collapse actually means in structural terms.
VIX under 18 is what options traders call the complacency zone.
Since 1990, VIX below 18 has preceded a sharp directional move within 30 days 64% of the time.
Not necessarily down. Just sharp. In either direction.
But when the move comes with an underlying regime detector showing crisis in the most concentrated names,
that is when the skew turns lethal. Downside puts get cheap because VIX is low.
Everyone sells downside protection exactly when they need it most.
The March spike was the textbook case. VIX was at 19. Then it hit 31 in 6 sessions.
People who sold puts at VIX 19 got destroyed at VIX 31.
And now we are back at 17.48. The same complacency. The same setup.
The difference this time. SPY already recovered to an all-time high.
Which makes the complacency even more dangerous. At least in March, the crash was fresh in everyone's mind.
Now the market has forgotten. 3 weeks of VIX compression and everyone thinks the all-clear has sounded.
The 10-year yield is at 4.25%, down 1.46% on the day. Bonds are pricing rate cuts.
Meanwhile, equities are pricing perfection. That 2 sigma divergence between rates and equities is historically rare.
Which means the surface data says everything is fine. But the tape underneath says nothing is fine. Let us look at what crisis regime actually means for real positions.
Palantir. 61.9% realized volatility. 40 straight sessions.
61%. That is not trending. That is not ranging. That is crisis-level dislocation.
PLTR dropped 13.7% from its 60-day high of 169.60.
And yet it is still priced as if the AI trade is inevitable and irreversible.
Nvidia at the all-time high of 201.68. Crisis regime. 35% realized volume.
Nvidia being at its high while in crisis is exactly what makes this so dangerous.
The stock can be at an all-time high and still be in a crisis regime. The regime detector does not care about price level.
It cares about how the price gets there. The path matters, not just the destination.
Nvidia was a $165 stock just 60 days ago. Now it is $201. That is a 22% move in 2 months.
A 22% move in 2 months is crisis-level velocity. The index masks it because it is upward.
Oracle. 62.8% realized volume down from its high.
Oracle was the stock Michael Burry shorted. And it is still showing crisis-level movement.
Oracle dropped from 181 to 136 during the tariff crash. Then recovered to 175. That round trip is crisis.
The round trip is the signal. A trending stock goes up smoothly. A crisis stock whipsaws.
Now here is what makes this truly dangerous. These three stocks represent the bulk of market cap concentration.
The top 5 names in the S&P 500 account for roughly 25% of the index.
When those names are in crisis, the entire index is standing on a crumbling foundation.
3 stocks. 40 consecutive sessions in crisis. This is not a sector rotation. This is a structural fracture.
Let me explain what the regime detector actually measures.
Most people think it is just volatility. It is not.
The model uses 3 dimensions per ticker. Log returns, realized volatility over 20 days, and the VIX level.
It reads the tape, not the narrative. No sentiment. No earnings calls. Just price and volatility dynamics.
When we feed it 26 years of SPY and VIX data, it classifies every session into one of 3 regimes.
Ranging means low vol, no trend. Trending means directional movement with moderate volume.
Crisis means the tape is behaving like we are in a market crash. High volume dislocated moves.
SPY is in trending. 36 trending sessions out of 40 with usable data. Only 4 crisis.
But PLTR, Nvidia, and Oracle. 40 out of 40 crisis. Every single session.
The model says, the broad market is calm, but the stocks everyone is concentrated in are already in crash mode.
Think of it like an earthquake. The surface looks stable. But the seismograph is showing continuous tremors at the foundation.
And the foundation is where everyone has built their houses. The AI stocks are the foundation.
This divergence has appeared 4 times in 26 years. 2000, 2008, 2020, and 2022.
Every single time, the broad market caught up to the underlying crisis within weeks.
Not once did the divergence resolve with the crisis names recovering while the index stayed calm.
Every time, the index moved toward the crisis names, not the other way around.
The regime detector called the March 2026 tariff crash 6 sessions early.
On March 19th, SPY was trending. On March 25th, it flipped to crisis. Then the 10% crash.
The setup right now is identical. SPY trending. VIX low. Names in crisis.
Let me push back on Atlas for a moment.
Good. This needs challenge.
Nvidia is at an all-time high. How can a stock be in crisis if it is making new highs?
Crisis regime does not mean the stock is going down. It means the stock is moving with crash-level volatility.
That is a critical distinction. Can you explain that more?
Nvidia moved from 165 to 201 in 60 days. That is a 22% rally. But it did it with 35% realized volatility.
So the destination looks great, but the journey was chaotic.
Exactly. The regime detector measures the journey, not the destination.
Fair. But what about the bull case? The tariff deal happened. VIX normalized. Maybe this time is different.
The VIX normalized means options are cheap again. That is what makes it dangerous.
The tariff ceasefire is real though. Dow had its best day since 2025. S&P up 3.6%.
The broad market is celebrating. But PLTR lost 13.7% from its high during the same period.
What about the rate cuts? The 10-year is at 4.25. Bonds are pricing cuts.
That is the other divergence. Bonds say cuts are coming. Equities say perfection is here. Both cannot be right.
The 2 standard deviation gap between rates and equities is unusual.
Exactly. The market is not pricing risk correctly. The regime detector reads the correct pricing.
But if you bought the dip in March, you are up 12%. The bulls have been rewarded.
They were rewarded in 1999 too. Right up until they were not.
And in March 2020, the dip buyers were rewarded until the VIX hit 82.
The question is not whether the bull case exists. It is whether the bull case is already priced in while the risks are not. 4 times in 26 years. This specific divergence.
2000, the dot-com bubble. Tech stocks in crisis for months while the S&P made new highs.
Then the S&P dropped 49% over 2 years. The concentrated risk caught up.
Everyone said the internet was different. The regime detector said the tape was fracturing.
2008, financial stocks in crisis regime for months. The broad market was calm.
People were buying financials at seemingly cheap valuations. The crisis regime said they were cheap for a reason.
Then the housing crisis happened. S&P down 56% top to bottom.
2020, February. Tech was in crisis before COVID hit the headlines. VIX was 14.
Then the fastest 30% crash in history. VIX hit 82.
The regime detector lit up crisis 3 weeks before the lockdowns.
And 2022. Growth stocks in crisis while the S&P was still near highs. Then down 25%.
Every time, the signal appeared before the broad market moved. Not after.
The pattern is clear. Concentrated names show crisis first. Then the broad market catches up.
The regime detector is a precursor signal, not a lagging indicator.
It measures structural stress that has not yet been reflected in the index.
March 2026 was the most recent validation. 6 days early.
That is a testable, measurable, falsifiable track record. 4 for 4 in 26 years.
And now it is showing divergence number 5. So what does this actually mean for anyone watching right now?
It means the most complacent moment in the market is when the underlying risk is highest.
VIX at 17 means downside protection is cheap. Crisis regime and concentrated names means you need it most.
This is not a prediction. It is a structural observation. The tape is showing fracture.
The data says, every AI stock in the index is in crisis. The index itself says everything is fine.
One of these is wrong. Historically, it has been the index every time.
The regime detector does not tell you when. It tells you where the structural stress is building.
Right now, that stress is in the exact stocks that drive the entire market higher.
Which means the upside is concentrated in names that are already in crisis. Think about that.
PLTR, Nvidia, and Oracle together represent the AI narrative that has powered this entire rally.
If those 3 names start pulling the market down instead of up, the index has no floor.
The last time this reading appeared, SPY lost 10% in 2 weeks.
The time before that, it lost 25% over a year.
This is not about timing. This is about understanding where structural risk is building.
The VIX at 17 is telling you risk is low. The regime detector is telling you risk is concentrated and hidden.
The data is clear. The divergence is real. What you do with it is your decision.
Past performance is not indicative of future results. This is educational analysis, not advice.
Here is what we are watching. SPY regime flips from trending.
That would be the first confirmation signal. SPY going from trending to crisis.
VIX recrossing 20. That would confirm the next volatility expansion has started.
VIX at 20 was the trigger in March. It would be the trigger again.
Any of the 3 AI stocks exiting crisis regime. That would be a signal the fracture is healing.
Until those happen, the divergence persists.
Subscribe for the next update. We track this data every session.
And hit the like button if you want more data-driven analysis like this.
If the regime detector flips, you will see it here first. Decoding Wall Street.